Two stocks I will never ever sell. I'm holding those stocks for the very long term. I love those companies. One of them has over a 10x upside potential and it's profitable. I'm not the one that likes to hype up stocks, so I'm going to show you numbers, show you a lot of different things on why I believe this will happen, why I'm invested in the company. The second one is a very interesting one. I recently bought the dip. It's presenting an amazing opportunity. I don't think it's gonna last too long. It's still trading at 10 times earnings. So I'm gonna talk about both of them, tell you why I own them and many different things. And this is something that I don't do very often. I very rarely talk about such stocks, especially disclosing that I own some smaller cap companies. Because I told you about Visas that I owned it, told you about Amazon. I've been pounding the table on those stocks and they did well. But I'm going to make an exception, talk about one small cap that I own, and it's an amazing company. And I really hope you enjoy it. If you do, please press the like button and let me know what you think in the comments. It would help my videos very much because maybe the algorithm have been hating on me recently, especially on Twitter. So this would help me very much. And thank you again. But in terms of when I'm looking for a very long-term investment for 10, 15, 20 years, I want something that has massive mega trends. That's what I would call them, mega trends, or maybe long-term tailwinds. If you look back, you could maybe think of the internet stocks or the internet transformation in general, digitalization, how everything was being transferred from physically to online. And companies like Amazon were just beneficiary of this trend. They just were at the right place at the right time, and they benefited from this trend. And this is what I want. I want a company at the right place at the right time that's benefiting from a massive, massive trend. And most importantly, I don't want to be late, I want to be early. And the main two mega trends that most investors right now are FOMOing in like never before are AI and quantum computing. Just go on YouTube. Everything you see is about AI, the next AI stocks, top 3 AI stocks to buy. Quantum computing stocks or whatever they are, and Google's been going up on quantum computing, which it should be going up, and maybe something about self-driving, about Tesla taking over Uber. This is all I'm seeing. But there's two main mega trends that everyone is missing, especially the first one people are clueless about. And if you watch this video and you pay attention to those mega trends, you're not gonna be late, you're gonna be early. And that's what I like being. I like being early. I don't like being late. And I don't like taking the risk of being late because the market is forward looking. And if you're buying SoundHound.ai over here, maybe you're a little bit late. That's all I'm going to say. But it doesn't seem obvious. It only seems obvious in hindsight. Okay. And this market, which is much larger than AI, it's much larger than quantum computing and self-driving. It's huge. And this is healthcare. Healthcare in the United States is a $4.4 trillion market. And for the first time ever, it's being disrupted in real time by one main factor or one main business model, I would say. And this is telehealth. Telehealth in the United States right now is expected to grow at a 24.5% CAGR. Just the market alone, not companies. The market alone is expected to grow at a 24.5% CAGR from 2024 to 2033. Now, how many videos are you seeing on telehealth? Most of the videos I'm seeing are about the top AI stocks to buy, quantum computing, Tesla taking over the world, and I hope it happens. But I'm not saying much about telehealth or about healthcare in general. Healthcare is the most important part of our lives. It's something that we need, especially quick access to healthcare at a much lower price versus the traditional pharmaceutical companies, which have been ripping off people for many, many years. And this is happening for the first time ever. And not a lot of people are waking up to this trend or are waking up to the companies that are disrupting this trend. And to me, it's insane. But in terms of this, kind of source that I have, and there's many different sources that would tell you the same, 20 to 24% CAGR. Some of them have it at the 29% CAGR. But the market right now is estimated to be around 62 billion in the United States. But this is excluding weight loss, which is very important. If you include weight loss to telehealth, which companies, they would ship you a lot of the GLP-1 injections. If you include it within telehealth, the weight loss market alone is 373 billion. So if we include weight loss within the telehealth space, the market of the telehealth right now is around $500 billion. So within 8 years, 8 to 10 years, could be $1 trillion and a half dollars. So this is a huge market, and not a lot of people are trying to get exposure to it, and it's driving me crazy. And I'm going to tell you my favorite stock, and this is Hims and Hers Health. It's down 9% over the last 5 days. And I just told you about how massive this market market is, how massive this industry is, and this disruption. And people are absolutely clueless about these companies. They're not even trying to do research. That's what's driving me crazy. I'm like, you guys are missing out on one of the best trends I've seen over the last 10 years. And you're being early in this one because people are not paying attention to it. Like when I talk about HIMSS on X, people, they just shrug it off. They say, oh, is this the next Teladoc? Is this like a Walgreens 2.0? What is this stock? They don't even look. They just focus on Palantir. I'm like, you guys are missing out on one of the best trends you're going to see ever. And HIMSS is a leader in the space. And I'm going to show you some numbers at the end. I'm going to show you some numbers on if they take 5% market share, how much upside the stock has. What if they just take 10%? And it's gonna blow your mind. And I'm starting to get excited. But the company, Hims and Hers Health, I own it. I bought it at $8, $5, $11, and $21, and I haven't sold a single share because I believe it's just getting started. And they're expanding in many different parts of telehealth, such as sexual health has 80 million people in the United States. Dermatology, 80 million, especially in hair loss. They've been huge in hair loss. They have hairspray you can spray on your hair and helps grow your hair again. It's like $60 a month. Now, if you go to another doctor, they do all these things. It's like $8,000 or $10,000. And a lot of people were able to regrow their hair with that spray. That's $60 a month, or certain pills if you don't like the spray. This is game changer. Mental health, 100 million plus in terms of in the United States. It's huge. And anxiety, depression, this is huge. And they're expanding into PTSD and different kind of things, which is going to expand their market in the future. You have weight loss, which was 100 million plus in the United States. And it's mainly a lot of things within insulin. And they do sell the GLP-1 compounded products. And I'm just going to talk about this one very quickly before I proceed in the video. But they do sell the GLP-1 kind of a compounded product, which is an alternative to the Ozempic that I believe NVO is selling. Now, the main reason they're able to sell this compounded product is because the FDA has GLP-1 on their shortage list. And this would allow Hims to sell this product. Now, once it gets taken off the shortage list, Hims will no longer be able to sell the product because it's not FDA approved. And this is how the whole company has been trading on. It's been trading on GLP-1 compounded that they're selling, which is only 6% of their revenues. And it's much more expensive than other alternatives. It's around $200 a month, and you have to pay 12 months in advance. So this is $2,400. And it's still much cheaper than NVO and others. I believe it's like $1,000 a month with them. Hims is $2,400 a year. Okay, but then they have another alternative, which is the weight loss pills. They kind of control your appetite, and there's another one that helps regulate, lowers blood sugar or whatever with vitamins. And if you just go look at some reviews, look at Hims Kit 5, Hims Kit 2, just look at that on Reddit, and people have had amazing results. They lost 10 to 15 pounds within the first 3, 4, 5 weeks, and it's been amazing for them. And this has nothing to do with GLP-1 FDA approved kind of stuff. And it's much cheaper at $69 a month. And you only have to pay 3 months in advance, which is around $300 with consultation and everything else. So if the whole thing with GLP-1 ends with Hims, it's not the end of the world, because Hims is still a leader in hair loss, is still a leader in acne and depression and sexual health, and even in weight loss in a lot of the pills that they're working with, and it's been going well for them. And the next date is December 19 for the FDA to decide if they want to keep it on the shortage list or not, and there might be some volatility until then. But I just wanted to talk about it. The company has been massively growing, 44% subscriber growth. So the growth has not been going down, actually has been going up because the market is huge. Revenue, 77% growth, absolutely insane. Profitability has been increasing. Adjusted EBITDA margin from 2.3%, 12.7%. They are GAAP profitable and net income profitable. But again, the company is not focusing on profitability right now. And they shouldn't be, because we're still early on in this mega trend that I told you about. And they should be focused on growth, on taking market share, and then they can focus on being profitable more in the future. But they are profitable. Okay, and they have a good balance sheet, there's no debt, which is very important. And the company is guiding not for revenues to start going down, but actually to start going up. And their Q4 guidance indicates 89 to 91% revenue growth. I mean, this is insane. I just can't believe it. And people are skipping this one, calling it the next Teladoc. But Teladoc was more into like health plans. They couldn't even make $1 per customer. Hims, I believe, makes $20 or $25 per order. I can give you the chart. I don't remember, but it's a huge difference. It's not even the same. Okay, but the analysts are very clueless about this one. And even though Hims guided this quarter now in Q4 for them to grow 91% in revenues, analysts are expecting the company to grow in earnings per share around 16.5% next year. I don't know what they're smoking. This is absolutely insane. I would be shocked to see 16.5%. The company was growing 200, 250% this year, and the growth has been going up, and the market and everything and the trend is just getting started, and they expanded in different things, and it's going to drop to 16.5. I would be shocked. I would be very shocked. This is not Celsius. This is not the situation with Pepsi where one customer is loading up on Hims products. I don't believe it's going to be the case. And if this is not the case, then the stock right now is much cheaper than it appears to be on a forward PE basis. But if you look at the forward PE of Hims, it's around 35 times earnings. And this is with stock-based compensation. And it's very high. But that's why a lot of you miss out on a lot of the growth companies, because you look at it right now and you see, oh, it's expensive. But it's more about the trend. So is stock-based compensation decreasing as a percentage of cash from operations over time? If the trend is going well and if everything is getting better, then this is all that matters, because you're investing in an early company. You're not investing in a mature company, and it's a very different mindset. But this is what I'm going to talk about in terms of the upside with the company in the telehealth market, assuming they take 5% market share or 10% market share. And I'm going to be very careful with this one. And I'm not going to include weight loss, even though by 2033, the patents of NVO and others would have expired, or maybe Hims would have worked on some kind of a FDA-approved drug or whatever for weight loss. I'm sure they would have done something by then. But I'm excluding weight loss out of the market, and I'm only taking 5 or 10% market share to make up for Amazon, which everyone is scared about, that Amazon going to take over telehealth. Hims should at least be able to get a 5% market share. I think you agree with me. I would say 20% market share, to be honest, but maybe I'm just being too optimistic. Okay, but if they get a 5% market share for Hims, which is very conservative, this is $23 billion in revenue. Now we're doing it by 2 times sales. I'm just going to give you a reminder. Hims right now is trading at 3 times sales. SoFi is trading at 6 times sales, and Palantir is trading at 41 times sales. So compared to other kind of growth companies in general, 2 times sales is very, very cheap. And I honestly don't think we're going to see it again. But assuming it does happen, and I believe this is very conservative, would be around 586% on the upside from today's price. Now, if Hims was able to get a 10% market share, this is excluding weight loss, only factoring in, 2 times sales, which is very conservative, that would be around a $46 billion market cap. And, we take it on 2 times sales. This is an upside of 1,273%. And the company is profitable with a clean balance sheet, GAAP profitable, and is getting better over time. And this is why this is such a high conviction for me. I've been averaging up. If it declines more, around $26, $25, I will happily buy more and hold it for the very long term. Now I'm going to talk about the second one, which I talked about before. It's a small cap stock with large cap kind of potential. I also think it has a lot of upside, not as much as this one. And it's trading at 10 times earnings. And this is Bird Construction, ticker symbol BDT. And it's down recently around 8%, which is very interesting to me. And if you want to buy the stock, you can't buy it on Robinhood or Webull. You would have to buy it on the OTC ticker. I can put it up on the screen. Or maybe you could, if you have IBKR, I have IBKR, for example. I have the link in the comments if you're interested. And I just click one button and I just automatically buy the stock. They convert currency for me and everything else. But the main reason I'm going through this hassle and I'm buying in a different currency is because I believe the stock is worth it. And I'm not a lazy person and I don't want to skip it just because I don't have access to this stock. Like, this is the last thing I want to do. I don't like missing on such opportunities. But Bird Construction is a construction company in Canada. Okay, and they specialize in many different things: building bridges, water, wastewater, mining, manufacturing, a lot of different boring industries. And I hope you don't skip, because I'm going to explain to you why it's a little bit different than your traditional cyclical construction company. Okay, and it's a lot of things within infrastructure, a lot of it within energy transition, wind, solar, carbon capture facilities. A lot of people can build that stuff. Nuclear power plants. Not a lot of companies can build nuclear power plants. Not a lot of companies have the expertise and have the licenses and everything to bid on them. And Bird Construction does have this expertise, and this gives them some kind of a competitive advantage to earn higher margins on high barrier to entry kind of jobs, like building nuclear facilities and many different kind of things. And this is what they do. And the main thing with Bird is the same with the infrastructure stocks in the United States. So if you go on, just look at any infrastructure stock, look at Caterpillar, look at United Rentals, look at Quanta Services. Those stocks, constructions, look at, I would put up some on the screen. If you look at some of the materials, like a lot of the concrete stocks or other kind of marble stocks or whatever they are, they're all trading at 25, 30 times earnings, and the market has been going insane on them. And the main reason why is because the market has finally realized that infrastructure is very old in the United States and needs fixing. It needs a lot of things to be changed, a lot of roads to be built, a lot of the wastewater treatments and many different things that's being in the United States, a lot of the old pipes, maybe a lot of the natural gas kind of pipes that will likely be going into a lot of terminals or will be going in a lot of the data centers, which a lot of them are being powered by natural gas, or maybe nuclear facilities in the United States, and many different things. We need more energy. We need a lot of new stuff. The infrastructure is old, and they've been getting a lot of contracts from the government. And the best part about it is that both parties of the government, they actually agree that infrastructure is old. So everyone agrees on that stuff, and everyone wants things to be better. And that's why the construction stocks in the United States, they're being bid up like never before to 25, 30 times earnings. And this is the same company, but in Canada, with the same kind of tailwinds, even more, because they're more into transitioning into clean energy, which they're giving a lot of incentives to construct, and then zero emission by 2030 or 2040 or whatever. And Bird is building a lot of that stuff. But it's the same setup, but at 10 times earnings instead of 25 times. And it's very, very exciting. And the best part about this one is they actually have a backlog, a massive, massive backlog that's growing 28% year on year. So they have visibility in revenues well into 2027. And this is where, I would always counter arguments of people that would say, yeah, but construction is cyclical, or construction is a bad business model. Just look at this chart. You could see a massive change. Not just in Canada, but also in the United States. Construction stocks have entered the bull market, and I think it's going to last 10 to 15 years minimum because of the infrastructure boom and a lot of things that need to be changed. And they have visibility well into 2027, and the backlog isn't going down, it's actually going up. So that would give me an extra margin of safety for investing in the stock. The stock or the company have been killing it. Revenues up close to 50%, earnings per share up 30%. This quarter alone, 9 months ended, 22% revenue growth, EPS per share up 42%. It's been absolutely, absolutely insane. And as I said, they have visibility well into 2027 thanks to the backlog, which has been growing, which is very, very important. And they expect at least around 10% organic revenue growth. So we have some numbers to work with. Okay, but this is at least 10% organic revenue growth, excluding any acquisitions, because the company has been doing at least 1 to 2 acquisitions per year, and each acquisition boosts EPS around 6 to 10%. So if they do one more acquisition next year and it boosts EPS by 10%, or I should say revenues by 10%, and revenues is growing organically 10% due to the backlog, this is 20% revenue growth. And earnings per share has been expanding faster than revenues because of expanding margins. So if revenue is growing 20%, EPS should be growing 30, 40% minimum. Okay, and this is how cheap the stock is. And you could see it how, the analysts are expecting 60% last year. This year was 43%. Next year is 37%. And I think it will be at least 20% EPS growth for many, many years to come, which is very cheap for a company that's trading at 10 times earnings. 10 times earnings, 20, 30% earnings per share growth, backlog visibility into 2027, playing into a tailwind that's going to last, in my opinion, at least 10 to 15 years. And that's why I recently bought a construction stock in the United States, but it's still trading at 8 times earnings. And it's like a small cap, which I don't share on YouTube. If you're interested, you could find the link in the description and you'll join my group if you want. I invest in a lot of those early companies and they have massive potential. But this is what I did with Bird Construction to try to value the stock. I used the current EPS, which is $1.98, and I took it over the next 10 years, and I expected to grow around 20% per year, which I believe is easily achievable with a company like Bird Construction. That would give me around $12.26 per share in earnings per share. The current price of Bird right now is around $27 Canadian, and if you time it by 10 times earnings, this is around $120, and the current stock is trading at $27 per share. And this is if it just trades at 10 times earnings. If it trades at 20 times earnings, which is very possible if it ever trades like the United States stocks ever do, and we take 20 times earnings, this is $245 per share, and we divide it by $27 per share. I mean, this is massive, massive upside, around 800% upside over the next 10 years with a company that's profitable, 2-3 year backlog at 10 times earnings. And this is why I decided to share those two stocks, Hims and Hers Health, Bird Construction. I'm not selling them anytime soon, but I might, change my mind someday. Nothing lasts forever, but I'm planning to hold them for a long time. And this is all I have. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I'll talk to you in another video.